Hi, this is Professor Karen Lin. In this video, we are going to talk about Chapter 3, Modeling and Evaluation. So in the impact model, we have talked about identifying the questions, mastering the data in our past 3 weeks. So now let's start talking about how to perform a test plan and to address the results that we might have. To identify an appropriate approach, our decisions basically made by a binary sort of decision tree. If we don't have any targets, we will be using descriptive or diagnostic. If we have a target in mind, we'll use predictive analysis. So what is a target? A target is an expected attribute or value that we want to evaluate. For example, if we know there is something that we are looking for in plain English, then you should be using predictive models. Now, I can give you an example. Let's say we are a bunch of internal auditors, right? We are going to a factory that's in a different country. We're trying to look for any inefficiencies or even any frauds in the financial or operation in that company, in that subsidiary. So if we know what's wrong, for example, we know the cost of that company, that subsidiary is too high compared to our knowledge about other companies or our other subsidiaries, then we have a known target. If that's the case, we're going to run, for example, a regression, right? We're going to run the regression. The left-hand side will be the cost of that company. The right-hand side will be all the variables that you think that would determine the cost. So that is something that we already know in mind, or we already have a suspect in mind. Then we are going to run a predictive analysis. We're trying to see whether using all these assets and all these inputs of production, whether the cost is too high or too low compared to other companies. If we don't have a target, on the other hand, we are a bunch of internal auditors. Again, we're going to go to the subsidiary, but we don't know what was wrong. What we need to do is that we need to describe the data. We need to take a look at what's wrong in the data. So, for example, we might be looking at, okay, their costs. We suspect there's something wrong, but we don't know what that is, right? We may run analysis, a descriptive analysis of their cost, of their revenues, of all their other production data. So in that case, we don't know what are the problems or the values that we are going to evaluate. So that means we don't have a target. An analogy of this is that if you go to the doctor's office, right, based on your symptoms, the doctor doesn't know what's going on. So what he might do is, or she might do, is to run like a lab, right? Those are descriptive and diagnostic. So run a lab of your blood and stuff. But once she or he expects that you have something going on, then they may compare, they may use some other models trying to see, for example, based on your blood work, they may think, okay, you have one type of diseases. Now what they have to do is that they need to compare your data with other people's, right? Or with compare all the symptoms with other people. So that's predictive because they already have something in mind to suspect that you have something wrong. All right. So the book discussed different methods and models, and the published video that I published on Canvas also talked about these different methods and models. I invite you to watch that video. In this video, my role here is to supplement some examples of those different methods, and I will also focus on statistic tools on large and random sample, which I believe it's important, especially in the future data analytics for accountants. So let me start with examples of data reduction. Data reduction is a method to reduce the large quantity or volume of data, trying to identify the results that you would like to find. And then you're going to filter the results, interpret the results, and follow up with the results. So what is an example of data reduction? Let's assume the internal auditors coming to a company looking for some types of data, but they were only want to focus on the payments made to Square vendors, which is the B and C, coded B and C in this data set. So data reduction means that we are only going to keep all the vendor related to the square vendors, which B and C. We're going to look at their amounts and see whether there are any abnormalities from those data. There are also very detailed methods how we can reduce large data. The first method is commonly seen or well-known is called sampling. Sampling involves selecting a subset of data points from the original data set. For example, we have a large database of the patients, right? And we are only going to we can't analyze all these patients, so we are going to randomly select some of the patients and you think they're representative of your population. That means we need to randomly select regardless of gender, regardless of age and stuff. So make sure, first of all, it's a large enough sample to do statistical analysis. Second of all, you are randomly selecting the data so that there's no bias or selection bias. That's what we usually call in your data sets. This is different from what I just said by selecting only the vendor that you wanted to keep. This is just a general discussion. By sampling, it's a random sampling. We are just reducing the amount of data work that we have to do, but making sure the smaller sample represents the original population. The second type of data reduction is called aggregation. So an example would be a high-frequency trading data. So if you look at the data that the exchanges, stock exchanges provided, it could be by seconds, right? Every second there are some trades going on. So the data you are going to see is like a massive data which you cannot probably, at least right now, you can't possibly manipulate or analysis. So what we do is that we try to aggregate those high-frequency trading data. Now, if you look at this SPY data, trading data, it's from 1:30 to 1:32 in the afternoon. So you can see just for like 2 minutes of trading, there are lots of data points already produced. So what we do is that we would aggregate all these trading data into, for example, a daily basis, right? We're going to aggregate all the by minute trading data as a daily trading data and look for the trading volume, look for the bid-ask spread and those kind of things, and try to analyze what we intended to research on. A third method is called data compression, which is most commonly seen in images. So for example, if you take a picture with your iPhone, it's going to be like a 2 gigabyte image. If you upload to your data set, it would be large, make your data set really large. What we could do is that by not losing too much information, we could do an image compression. This is what I found on the internet. Without compression, you can see the color is more vivid. There are more details, but they didn't, I mean, they are not that different by the amount of information they provided. You can see this is a peacock, right? And you might or might not be able to see the background of it. But anyways, with compression, we could reduce the size of our data. In conclusion, data compression is a useful tool. It's a useful tool that we could use to reduce the data size and try to do analysis based on it. The second method we talked about is called profiling. Now, what is profiling? Profiling usually is first of all, profiling is a diagnostic analysis because you're trying to figure out what's going on in the data set, right? So, for example, you are trying to analyze travel and entertainment T&E expenses for violations of internal controls. What are you going to look for, right? You're going to look who are the top spending employee. You're going to see the merchant's code, out-of-pocket expenses, weekend and holiday tests, right? Whether they use the company's resources, take a taxi in the weekend, which is unrelated to work, might be unrelated to work. So that's called profiling. A famous example is the Benford's Law. The Benford's Law is an important rule that in accounting to trying to figure out the potential fraud. The idea of Benford's law is that the first digits of any number, okay, in a data set should follow a certain distribution look like this, right? So more specifically, in a theoretical model, researchers proved that, for example, the first digit of a number which starts with 1 is 30%. With 2 would be 17%, 17.6%, so on and so forth. So if you are looking at a large sort of data set of, say, expenses, right? You have people reported expenses to in a data set. You try to pull all the first digit and you plot the distribution of first digit. It should kind of look like this. Now, if the data is fake, someone tampered the data or manipulate the data in a significant way, you will see the first digit of those numbers does not follow the Benford's law. So the Benford's law is actually a good example of profiling, because just by looking at the first digit, we are trying to figure out what's wrong, or is there anything wrong with the data set that you are seeing. All right, this is the first part of this week's lecture. In the second part, I'm going to talk about statistical testing with a target, which is hypothesis testing. I'll see you in the next video.